Welcome to the YouTube channel of Michael J. Swanson. Michael is the author of How David Beats Goliath and is the CEO of Advocate Capital. And now, here's Michael.
Hi everybody, Mike Swanson. Today I'm going to talk a little bit about using the partner's after-tax cash in a contingent fee law firm to fund the practice, to fund mainly the case expenses. This is by far the most common form of capital that a contingent fee law firm uses, but most often it's done without a lot of forethought, not a lot of planning ahead of time. It's just kind of a default, if you will. There are bills to be paid, there are case expenses to be paid, and so they write checks from the checkbook of the law firm and don't give it a lot of thought. But I think it is important to examine that decision to use partners after-tax cash for that, simply because it involves many times tying up hundreds of thousands of dollars of cash, sometimes millions, for 10 or 20 or 30 years. So if you're going to tie up that kind of capital for that period of time, it's important to give it a little bit of thought. So here's a couple things I think get overlooked in that case. First, where did that money come from? Well, it came from net profits of the partners. Let me explain. When fees are earned at the law firm can deduct certain things as deductible expenses from a tax standpoint. They can deduct overhead, salaries, utilities, these kinds of things. Once they've deducted all that, they have profit hopefully left over after that. After that, they pay taxes. Now the cash that's left over is the owner's after-tax cash. And they don't often think about it that way. It's just kind of the cash that's in the checkbook. So imagine, if you will, that I'm a lawyer and I have tied up $300,000 of my own after-tax cash in my cases. Imagine now if I had that money sitting in front of me on the table in cash. It's my money. I paid taxes on it already. I think we can all agree it wouldn't be a good business decision to take that cash and loan it to my business, my practice, at 0% interest for 20 or 30 years. That's just not a good business principle, right? But that's exactly what these law firms have done if they've used their own partners' after-tax cash. Those case expenses aren't expenses from a tax standpoint, and that's not my personal opinion, that's the IRS's opinion. There's a private letter ruling, it's number 824-6013. Send me an email if you want a copy. And it says that case expenses advanced by contingent fee law firms are not expenses, they're loans. So they're not supposed to book them on the income statement as an expense that they can deduct from a tax deduction standpoint. They're supposed to book it on the balance sheet as an asset, because there's a high probability that those funds are coming back to them. Well, most law firms haven't thought about it that way. They've made an interest-free loan into their practice. But there's a real opportunity cost to the partners for not using those funds somewhere else. So they could say, okay, well, so what? I've loaned some money to my law firm, interest-free forever, what's the big deal? Well, the big deal is, what could you do with that cash if you had it out? So there's an opportunity cost, and there's also the time value of money. Again, I get into more detail in the book. The opportunity cost is, what could I do with that capital if I had it and could deploy it elsewhere? Can I get more cases, do a better job for my existing clients, hire more staff, whatever the law firm might need? But also the time value of money. We all know that $1 today is worth way more than $1 will be in 20 years from now, so there's a time value calculation. Again, more details in my book. It's covered in Chapter 12, and I hope you'll stay tuned for further updates.
Thanks for watching. Send your questions or comments to Michael at mike@howdavidbeatsgoliath.com.